You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Burberry, Persimmon, SSE, Taylor Wimpey, Experian, and our US company of the week is Netflix. Sam, do you want us to kick us off with Burberry?
Yes. So, company we have covered multiple times before. I don't think needs a huge amount of introduction. I think most people should be pretty familiar with the Burberry brand. And it's a company that's, in the whole time we've covered it, I'd say never done particularly well, or never sustainably done particularly well.
It's always been awaiting the turnaround.
Yeah, and you've maybe got the first year of the turnaround or the second year, and it's never quite got to the end of the turnaround. It's always kind of reverted back to form, unfortunately. But this turnaround might be different. So Burberry have come out with their interim results for the 26 weeks ending 27 September 2025, and revenue was down 5% in reported currency, but 3% in constant currency. Adjusted operating profit swung from negative 41 million to positive 19 million. So that gives an adjusted operating margin from negative 3.8% to positive 1.9%. The adjusted earnings per share swung from a loss of 18.3p to a profit of 0.6p. And the reported loss lowered from 53 million to 18 million loss. The reported operating margin also improved from negative 4.9% to negative 1.7%. And the reported diluted loss per share improved from negative 6.8p a share to negative 7.1. And the free cash flow improved from negative 184 million to negative 50 million. In terms of the difference between those reported figures and the adjusted figures, the main adjustment was a restructuring charge of 37 million, which they've said has resulted in the reported operating loss. That's probably okay. I think that will. That being said, the amount of turnarounds this business has had, you should maybe argue that the restructuring costs shouldn't be adjusted out because they seem to be pretty regular. Anyway, the new CEO, Joshua Schulman, has said, 1 year into Burberry Forward, my belief in this extraordinary British luxury house is stronger than ever. With the consistency of our timeless British luxury brand expression and an improved product offer, we have begun to see customers return to the brand they love, reporting in comparable store sales growth for the first time in 2 years. While it is still early days and there is more to do, we now have proof points that Burberry Forward is the right strategic path to restore brand relevance and value creation. We move forward with confidence that Burberry's best chapters lie ahead. So Burberry Forward, that is the current turnaround plan, and that is the brainchild of the new CEO, Joshua Schulman, and the idea of it is an overarching strategic plan to position Burberry around timeless British luxury, doubling down on its heritage, trench coats, check pattern, and the outerwear as the core of the brand. So it's emphasizing the British heritage, the outerwear and the scarves, and a more coherent product pyramid instead of chasing trend-led fashion at the expense of core items. They're wanting to refine wholesale relationship. Yeah, so I think the idea is rather than go from trend to trend, and you don't really know what to get when you walk in if you've not been in for 6 months, the idea is they're going to have certain core brands like the outerwear and the scarf patterns. And then beyond that, they might do some seasonal stuff, but you kind of know what you're going to be getting going in, which seems to make sense to me as a layperson, but as someone with no real fashion knowledge, I don't know whether that's good or not. If we look at the comparable store sales by region, for the half, the group was flat, and that was made up of positive growth in Europe, Middle East, Africa. I don't know what the I is. There's an I in there. Europe, Middle East. I guess it could be India. Europe, Middle East, India, and Africa, I guess, maybe. Anyway, that's 1%. Americas is up 3% for the half. Greater China's down 1% for the half, and Asia Pacific is down 2% for the half. If we do it quarter by quarter, the first quarter was much more negative for basically everyone except the Americas. And then the second quarter, no regions had decline in sales. The worst was Asia Pacific, which was flat. So there does seem to have been some stabilization there. They've highlighted a strong customer response to autumn and winter 25 collections, initial momentum in outerwear and scarves now extending to other categories. They've enhanced the in-store experience with elevated product displays, cross-category merchandising, and new clienteling tools. Launched over 100 scarf bars to date. I don't know what a scarf bar is, and remain on track to deliver 200 by year end. They're attracting new customers whilst welcoming back existing customers to the brand with sequential improvement in customer growth. And the cost efficiency program, which is what has led to the 37 million of restructuring charges, that's on track to deliver 80 million of annualized savings by the end of the 2026 financial year. So in terms of the valuation, I mean, it's really difficult to value now because it has done so badly. We now don't have any earnings. It's got a market cap of 4.44 billion and there's no dividend anymore. I would be really, really reluctant to try and normalise the earnings because as we've talked about earlier, they've been so up and down in the time we've covered it. This isn't a business that's been very consistent and they had a drop off. So I don't know what the normal earnings would be or the earning potential. That being said, the market cap of 4.44 billion, I think if they can get the turnaround right, my instinct is that seems low. In terms of the share price, shares are currently trading at £12.40 a share. Pretty close to the 52-week high of £13.75, but they're about double the low of £5.97. In terms of the longer-term performance, they're up 37% for the past year. They're down 42% for the past 3 years and down 31% for the past 5 years. And over 10 years, they're actually pretty flat. I think these results are pretty decent. It seems the turnaround might have some signs of life in it. I think it's really, really positive that they've done the cost-saving program, which seems to be about to bear quite a lot of fruit in terms of those 80 million of savings a year. But at the same time, they have stabilised the sales. What I would want to see from Burberry, however, is some consistency. I think I'd need another 6, 12 months, maybe even 18 months like this to say, well, actually, they have now steadied the ship because it has been such a yo-yo that it wouldn't surprise me if in 12 months we're kind of back where we were 2 years ago. That's my concern with it. That being said, as I've said, it's really, really hard to value. For someone who doesn't really know anything about fashion, I think it's just not for me. And I don't know how I'd assess whether it's undervalued or not because it's so dependent on that turnaround. And like I say, they don't really have that track record in terms of execution. What about you, John?
Yeah, no, I think I would feel similarly to you, and I would again agree largely with what you've said. I think if we did look at more of the bull case on it, it would be to a degree how strong that brand could be, and particularly that historically that brand has been popular in Asia, particularly amongst Chinese people. And if you got back to significant growth in China, if Burberry continued and they could build on that historic popularity, then there could be a lot of growth ahead of Burberry. But I think there are a lot of ifs and buts there. And I don't think it is the strongest brand. Fashions change very quickly. I think, as you alluded to, or just openly admitted, Sam, you and I don't know very much about fashion. I think when the last time we thought we knew something about fashion, that was the case of Boohoo, and that ended badly for both of us. So I wouldn't be going near Burberry, quite honestly. I think at different points I have been tempted by it, but now I think I'm I'm sitting out on the sidelines with this one.
Should we move to one that is probably a lot easier to understand?
Yeah, literally bricks and mortar. So Persimmon, which I think is the second largest house builder in the UK. It's York based. It's one that I've owned in the past. I've also owned Taylor Wimpey before, which is the second house builder of the week. Anyway, Persimmon had their Q3 results out with average weekly net private sales rising from 0.7 to 0.76 since the midpoint this year, despite some softening in the market since the summer. The group called out the continued affordability pressures and uncertainty ahead of the upcoming UK budget, which obviously has now happened, as a key challenge to contend with. The order book rose by 15% to £2.8 billion, driven by volume growth in both private and partnership sales. Average selling prices were up 1.5% to about £295,150, with buyer incentives stable at between 4 and 5%. Full year performance is expected to be in line with current market expectations, pointing to underlying pre-tax profits of around £429 million compared with £395 in 24, and cash balances are expected to land up to £200 million at the year end. And the shares were up around 4% in early trading. I thought these results were, given the market, were actually pretty reasonable. And I think you see the market reaction to those. Without any spoilers, we'll come on to Taylor Wimpey later, which didn't fare as well. When it comes to valuation of Persimmon, and again, this is it very much these results reflected in the valuation, it's got a market cap of £4.3 billion and a forward price to book over the next year of 1.06, compared with a 10-year average of 1.89. Prospective dividend yield of 5.3% compared with the 10-year average of 7.5%. I think it has been a difficult couple of years for the house builders. Rising interest rates, increased inflation, which is obviously affecting their build costs, softer market generally, affordability has dipped. I think they have had a tough time. They've been in a much stronger position, and certainly when it comes to cash, in a much stronger position than they were around the sort of 2008 crisis. I guess what I think it does come down to with Persimmon, Taylor Wimpey and all the UK house builders is that we've talked about them for quite a while on the show, waiting for things really to kick off in terms of delivering on growth, because there's been so much talk from, well, both it was Labour and Conservatives, that obviously there's the structural imbalance of the demand for housing and that we need more houses to be built in the UK. Obviously, the big house builders are the people to deliver that, or the only credible people to deliver that. Yet with planning and I suppose the economy overall, we just haven't seen that demand realised in terms of the supply and building more houses. And because we haven't seen that, there are some encouraging things like, the order book rising by 15%. We haven't really seen things sort of kick on. And yes, these companies are, by historic standards, fairly depressed valuations. If you were a shareholder, you haven't seen very much return, if any, over the last 5 years. I think probably through dividends, yes. That being said, I still have the long-term hope and optimism. But I think looking at my shares in the house builders, they haven't done terribly, but they've definitely underperformed most of the rest of my portfolio. So I don't know. It's a tricky one. What do you think, Sam, of these results from Persimmon and the UK house building sector as a whole?
I think these results, well, they're obviously pretty positive. Yeah, so Taylor Wimpey's average price is about 350,000, whereas what's Persimmon?
It's
295,000.
Yeah.
What's the regional difference? Would it just be regional difference?
I think it'll be regional difference.
Right,
so I
they're
think
not different ends of the market.
I think they're probably, Persimmon's definitely, entry level, but I think largely Taylor Wimpey is, more geared towards that too. I think probably the big difference is geographical, and Persimmon being more northern, basically. It's York based, but being more northern.
So they're both in the sort of, like you say, both in the same market, targeting like first time buyers, lower end. But Persimmon emphasises more affordable housing, particularly in northern England. So yeah, I think that's basically bang on what you said. So yeah, I think these results are pretty positive. I appreciate they are doing quite well, and I don't want to spoil the Taylor Wimpey results, but as you've alluded to, they've done better than Taylor Wimpey. But I think that prospective yield has been pushed down quite a bit now, that I do think I'd probably be more interested in Taylor Wimpey. I do quite like Taylor Wimpey as well. I thought they were quite good operators during the pandemic. So yeah, I think the results are very positive, but there's a bit of a difference in valuation now between Persimmon and Taylor Wimpey, and I don't feel like there's enough difference between the two to justify the lower yield from Persimmon. What do you think?
Yeah, I would tend to agree with you. I mean, at the moment, I have Barrett Redrow. So I haven't looked at them for a little while. Yeah, I would side with you on that. And I was impressed with what Taylor Wimpey did with its adding to its land bank at the rock bottom valuations during the pandemic. I thought that was really a smart move.
Should we move on to utilities then before moving back into house building?
Yes. How are SSE doing, Sam?
They're doing okay, actually. So SSE, they are the utility company for anyone who's not familiar with them. So they have come out with first half results, and revenue rose by 4% to 4.6 billion, which was helped by inflation-linked tariff increases in transmission. Underlying operating profit fell by 24%, and the sharp decline was by distribution and renewables, with the latter suffering from unfavourable weather. Free cash outflows worsened from 46 million to 600 million due to increased levels of investment, and the underlying net debt rose by 1.6 billion to 11.4 billion total. Full year profit guidance is expected to be announced later in the year. And they've also announced a 33 billion 5-year investment plan to 2930. Around 27 billion is to be invested in its regulated UK electricity networks, with the remainder to be spent on renewables and system flexibility projects. To fund the investment, SSE is issuing new equity to raise £2 billion, which is around 9% of the market cap prior to the announcement, and the shares were up 12% in early trading following the results. Although the first half revenue was up by 4%, as we said, the underlying operating profit was down by 24%. They've put that down mainly, basically, to tough comparables. So they said there were a number of one-off items that benefited last year's number. They've also highlighted that although the net debt to EBITDA is projected to rise in the next few years with that investment up to 2930, it's expected to remain below the group's 4.5x limit. In terms of valuation, the business trades at a forward P ratio 11.2, and that compares to a 10-year average of 12.8. The prospective yield is 3.6%, and that compares to a 10-year average of 5.5%. These results are okay. I think the first half revenue raise is decent, but it's inflation linked, so you would expect it. The underlying operating profit, if we assume they're correct about it just being due to tough comparatives, then that's fine. It's not a terrible business, but I just think they are expending huge amounts of capital in the next few years. There's already quite a lot of debt. They're raising equity to do it. I'm surprised the reaction to this has been so positive, and it might be that there is something I'm not aware of in terms of expected to returns or something. But I just think when the valuation's been pushed to a point where the yield's at 3.6%, this isn't a company I'd expect to have huge capital growth. So I don't really understand why people are holding it. I'll see if I'm missing anything. So it seems a lot of it seems to be focused on like the net zero transition, which surprises me, because I mean we've seen it in there where obviously I don't know whether it's the wind's not blown enough or something else, but that's not done particularly well. And when we've seen BP in particular where they're moving back towards the traditional kind of oil and gas and they're focused on that. So I'm surprised investors are so positive on this to the point where they've actually pushed the yield down on a utility company to 3.6%. Because I just think you'd have to have a very different outlook on the future of the renewables business, I think, to justify it, because there's actually quite a lot of capital growth probably factored in there, because you could get more money in a bank. So yeah, I'm surprised it's valued so highly. What about you, John?
I'm not sure whether there is an element of it being targeted by ESG funds and qualifying and therefore perhaps being bought more. I don't know whether that's causing any sort of distortion, but I would agree with you. I would be expecting more for sort of the traditional utility dividend play. There's quite a lot of capital expenditure, and as you say, with BP and Shell, they're moving away after investing significant sums in the renewables. And again, you would wonder what the UK energy policy is going to be going forward and whether there is any sort of seismic change to that. I mean, you certainly think about reform in the polls, and if they were to ever form a government, what would the policy towards the sort of renewables be? And if you started drilling, for example, North Sea oil and gas, then does that, come back to SSE in a very negative way? I don't know, but there's not enough return in it either from a capital growth or a dividend to make me at all interested. And I think the politics of it are risky. And I'm saying that as someone who owned Centrica and did get quite badly burnt when, again, politics came into it. And I just would be staying away from those, what I consider more politically risky stocks.
Should we move back to a stock then that's safe as houses?
Okay, but is the politics still in, and the planning system still impacts on it an awful lot. So yeah, it's Taylor Wimpey, which is the second of our house builders. Taylor Wimpey also had their Q3 results out with average weekly net private sales falling from 0.71 to 0.63 since the mid-year point. The group called out continued affordability pressures and uncertainty ahead of the upcoming budget, same as Persimmon, as drivers of the slowdown. The order book fell by around £100 million to 2.1 billion, reflecting a backlog of 7,253 homes, and underlying prices has remained broadly flat over the period, and build cost inflation remained at the low single digits. Full-year guidance was reiterated, with the group expecting to build between 10,400 and 10,800 new homes and generate around £424 million of operating profits. And the shares were down nearly 3% in early trading. In terms of valuation, Taylor Wimpey has a market cap of £3.64 billion and trades at 0.89 forward price to book, compared with a 10-year average of 1.4. And its prospective dividend yield currently is 8.8%, and that compares with its 10-year average, which was 8. I thought these results, obviously it's disappointing to see the average net private sales falling, and they've obviously got the backlog in the homes. I think looking at all the house builders, I suppose obviously more positive with Persimmon, even in the circumstances, managing to increase things. I think some of this does come down to the regional variation as well, and Taylor Wimpey not having as much northern exposure as Persimmon. But overall, I think when you come to these sort of valuations, none of them are particularly commanding. And I think if we did see a significant relaxation of planning rules and planning laws in this country, you would expect all of these ships to rise with that tide. And they certainly are paying out a very healthy dividend. So I wouldn't be concerned at all as a Taylor Wimpey shareholder. I think it's interesting when it comes to build cost inflation. I think with Persimmon, they actually have some of the manufacturing in-house, which I don't think Taylor Wimpey do. So potentially on that, Persimmon are slightly more insulated, but I wouldn't say there's huge differences there. So I think historically they've been a good operator, and I would back both companies, really. I think if you went back maybe 5 years ago, there were a lot of build quality issues with Persimmon. I think they've largely been dealt with. But I think my summary of it would be much the same as with Persimmon overall, and I suppose the UK house building sector. I suppose as an investor, it's whether you think there's value there, and also whether you're prepared to really wait it out, because there's no guarantee. As much as Labour, I think, is saying it's going to be 1 million new homes, that's when in these numbers you're just not seeing that. I guess wait and see. Sam, any more thoughts?
I largely agree. I think in fairness, with the full year guidance being reiterated, obviously this was pre-budget. I think there wasn't really much in the budget that I think would be really positive to house building as a sector, but I don't think there was much that was that negative either, in fairness. So I would expect a lot of people who'd maybe been holding off completing on a sale to now get a move on following the budget. There's something else I was going to say. Oh, that was it. Also, mortgage rates, I think, have started to creep down a bit slightly as well. So in theory, that should make them more affordable. So it's probably a couple of short-term tailwinds, I think. So, and obviously longer term, I know we're still waiting to see it, but at some point, someone's going to have to start building more houses.
Yeah.
But yeah, I think they're a good operator. And I think, if whilst you're waiting for the housing market to pick up, you're getting an 8.8% dividend yield, you could do a lot worse whilst you're waiting.
Very much so. Very much so.
So, you'd be quite happy sitting it out. And at some point, you'd hope those long-term factors will actually start to kick in.
So on to a bit more of a growth company then, Experian.
Yes. So Experian, it's one we've covered quite a few times before. And I think probably come to appreciate a bit more the more we've covered it. I think a lot of people probably will be quite familiar with Experian now. I think a few years ago, it was maybe a company that maybe looks a bit more in the background, but I think most people probably have had some kind of contact now, I think. Experian, they're a company that collects and analyse data about people and businesses, mainly focus on credit information. So they help banks, lenders and businesses decide who to trust with loans, detect fraud and find the right customers using their large databases and software. They also charge businesses regular fees for access to their credit reports, data and technology tools, as well as earning from one-time fees for credit checks and from services to consumers like credit monitoring and loan advice. So as an example, a couple of years ago, I worked for an employer and they had a data breach, which included some of the staff data. And one of the things they gave everyone was 1 year free subscription to Experian's data monitoring service. So it would regularly check to see if any of your data had kind of been leaked online. Yeah, so Experian, they have come out with their half-year results and they do report all their figures in dollars because a lot of the business is American-focused. And they reported first half revenue growth of 12%, excluding exchange rate moves. And that reflected organic growth of 8% compared to 7.9% expected. And growth was broad-based across geographies and business lines. Underlying operating profit rose 14%, with margins up to 28.3%. And underlying free cash flow was up 26%, and net debt ended the half at 5.2 billion, and that's on an underlying operating profit for the half of 1.1 billion, which, given that's only the half-year figures, if you quite crude and just double that to 2.2 billion, I think net debt of 5.2 billion is not a huge figure if it's sort of 2.5 times the annual operating profit. An interim dividend was announced, which was up 10%, and the full year guidance has been raised. So revenue growth is now expected to be 11% for the year, with 8% organic growth, and margins are on track to improve by 30 and 50 basis points. And the shares fell 1.4% following the announcement of the results. In terms of valuation, the business trades at a forward P of 24.3, and that compares to a 10-year average of 25.7. The prospective yield for the next 12 months is 1.6%, and that compares to a 10-year average of 1.8%. I think for a business of this size, I think revenue growth of 12% is really, really good. I think the operating profit rise of 14% is also really, really good. I think it's probably as much as you could really expect from a business of Experian size. I just struggle a bit with the valuation because at a forward P of 24.3, I think you are paying up for it, but it can't help the value it trades at. And I think I can kind of understand it a bit because it is a really, really high quality business. So for me, I'd want to see it a bit cheaper before I actually took a proper look at it. But yeah, great business and I think really good set of results. What about you, John?
Yeah, I mean, I think it's very high quality, and the many uses of the data that they have and the value of that, it's difficult to put a price on. Probably the current share price is a little bit expensive for me. However, they can't help that, and it has continued to perform actually over the time that we've covered it. So I wouldn't bet against it, and I do like it.
Should we move on to Netflix then?
So this was really the news earlier in the week, with Netflix having agreed to buy the film and TV studios plus the streaming divisions of Warner Brothers in a cash and stock transaction. Essentially, Warner Brothers will spin out its cable TV assets in advance of the transaction, and the agreement is for 23.25 in cash and around 4.5 worth of shares in Netflix stock for each share in Warner Brothers. and this values Warner Brothers at around $72 billion, or 82.7 if the debt is included. Obviously, shareholder and regulatory approvals are required before the completion, but it's expected to be done in around 12 to 18 months. And interestingly, the shares were down in Netflix around 3.1% in early trading. For reference, Netflix has a market cap of $441 billion, and it trades at 32.5 times forward earnings, with a 10-year average forward PE of 71.7, and it doesn't pay a dividend. I thought this made a lot of sense for Netflix. It's difficult because we haven't really dug into Warner Brothers and exactly how much they're paying, on a value basis for Warner Brothers. But as having that content creation and the library that Warner Brothers have, I think makes a huge amount of sense for Netflix. And I suppose it was sitting out there as sort of a streamer that I think had a few hits, but was increasing the quality of its script writing. And I think now that you've got that really established company essentially brought it in-house, I think that you will get the synergies from that, and it will pay dividends in the longer term. And I think it's something as a Disney shareholder that now I feel a little bit more uncomfortable with, because I think before, it could be a bit hit and miss with some of the Netflix series. The last couple of years, it has very much been hit rather than miss. But I was maybe sort of slightly complacent there. And now I think this does make Netflix an even stronger competitor, and probably adds to the quality of their business, a lot of which is based on the quality of their content. So I think on the surface at least it looks like a smart move. Sam, what are your thoughts?
Just before I do my thoughts, do you think the deal should be allowed to go through?
What, from a competition and markets sort of perspective? I suppose it's a tricky one. I don't know what share Warner Brothers has of the overall market. I suspect it's probably not what it had 20 years ago, but I think probably on balance I don't think it would be monopolizing the industry too much. I think it's probably okay. That would be, and that's without obviously digging into it in any great depth, but I think it's probably okay.
I would agree with you.
Maybe as a Disney shareholder, I would say no, no, absolutely not.
But I agree. I think when you look at it as well in the wider context, if you look at some of the other streaming services, obviously Amazon bought, is it MGM it's called?
Yeah.
The one that has Bond films.
Yeah.
So they bought them a few years ago. Disney, I know it's before they were streaming, but Disney bought 21st Century Fox. So they brought a load of big brands in-house with that. So I think in the context of some of the other deals that have been allowed to go through, I don't see why they shouldn't be able to buy Warner Brothers. And I think if anything, it will probably allow them to compete better with the likes of Disney and maybe even Amazon. Although I know Netflix has done really, really well, but it's like if you're to name the Netflix-only brands, it's quite difficult. Like apart from Stranger Things, I don't think they've really had that many. I know they've had some big hits, but a lot of it shows where then after a couple of years, no one's really bothered about it and they need to keep having them. They don't have that IP they can keep drawing on. And this absolutely gives them that. So within the Warner Brothers universe, you've got DC, so you've got all the comic stuff. You've got Game of Thrones because you've got HBO. I mean, some of the quality stuff you've had on HBO over the years that they'll now get. Harry Potter, Lord of the Rings.
Yeah.
I think as a Disney shareholder, it's probably the most concerning thing
yes.
that could have happened, because those brands are absolutely up there with some of Disney's. And Netflix has probably been a better operator than Disney, certainly in the time we've owned it, but we've always been able to fall back on the quality of the brands. And now I think, if you go up and compare them, yes, Disney's got some of the best IP in the world, but so does Warner Brothers. And I think that makes it really, really difficult for Disney, probably. I suppose fortunately people can have more than one streaming service, but yeah, brilliant deal for Netflix. I think like you say, we've never looked at Warner Brothers, so we don't know if they're overpaying or not. But I mean, you look at the amount of money Netflix is churning out. I think it'd be actually quite hard for them to overpay for these brands, because when you think about what they could do with them, not just for like 5, but 10, 20, 50 years for some of this IP, I think some of this IP really, it's almost priceless, really.
Yeah.
So yeah, really, really good deal for them.
Yeah.
Annoyingly good as a Disney
That's right. It genuinely, since hearing the news a few days ago, it has made me reflect on Disney, and I'm like,
I think as well, obviously we weren't to know what was going to happen, but when you think a few years ago, you really had Netflix at a hell of a discount. When the subscriber numbers were dropping off a bit more, and then they've turned that around. But yeah, really, really good deal.
Yeah. And I suppose to a degree, maybe not 72.5 times earnings, but when you've looked back at Netflix and it sort of fell from the FANG, and it was like, well, that one was, the poor quality cousin, and actually now you're seeing what it's doing, and it's really, really operationally impressive.
So, of the 6 businesses then this week, Burberry, Persimmon, SSE, Taylor Wimpey, Experian, and Netflix. Which do you like the most, and which do you like the least?
So I probably like Experian the most, although it is pricey. I think in my own portfolio, I do have a soft spot for the house builders, although they haven't been performing. And I think you could make an argument on a valuation basis, but I will go with the quality, which is Experian. And what do I like the least? That's actually tricky. Burberry and SSE are both down there. I'd probably say Burberry at the moment. What about you?
So, if valuation wasn't a factor, Netflix would be the one I like the most now. But it is a factor, so I think I'd probably go Taylor Wimpey. It's like the most. I just think it's a quality operator. It's not the best set of results, but I think that dividend yield's very, very attractive. Plus the long-term tailwinds. In terms of like the least, I think for me it would probably be SSE. I'd be very, very uncomfortable owning it. I think with that infrastructure investment, with the reliance on the renewables going forward, and it's in a sector as well where it is a bit of a target. It might be doing okay at the minute, but it would still make me a bit nervous. So SSE for me, I'd probably rather own Burberry than SSE, I think.
Okay, fair enough. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.